Hi, this is Randy Finney with Right Side of the Chart with a market wrap for the week ending June 15th, 2018. We'll start out here with just a quick look at the futures, only in the 60-minute time frame. That's where I've been focused a lot lately. This is the S&P 500 E-mini futures. Same story. I posted some static charts this morning right after the market opened, and what I'm watching on the ES or the S&P 500 E-mini futures is this bearish rising wedge pattern confirmed with negative divergences. It did break down recently. You can see we had the impulsive selling, which is what you want to see following a breakdown of a wedge, a little kickback rally, and we have been moving lower since. So, the intermediate term trend is certainly upwards. The longer term trend really year to date is sideways. The S&P has gone nowhere for the most part. We're about where we started the year, give or take. And the very near term trend is down. A downtrend is defined as prices making a series of lower lows and a series of higher highs. So there you have it. Intermediate term trend bullish, very near term trend bearish as of now. And again, it's more about the posture. It's one can sit here and say what the trend is or isn't or what happened. But again, I focus on what's going to happen on the right side of the chart, meaning anything to the right of price. And based on what I see here, I still favor more downside from here. These remain my targets, give or take about 27.44 on ES and possibly a move down to 27.08 or somewhere in there. Let's look at NQ real quick, and then we'll look at the index tracking ETFs after that, QQQ and SPY. So the big story is, the SPY has broken down. We're seeing some weakness in some sectors, strength in some others recently. Sort of a mixed bag, but overall, again, the trend has been lower near term, but it's continued. We continue to be an uptrend in NQ, or I should say the Nasdaq 100. So this is a trend line, or actually I should say a bearish rising wedge. We do have an uptrend line here, pretty clean, a lot of reactions. And again, I always say this: the SPY isn't going to go anywhere without the Nasdaq 100, and vice versa. In other words, they can sure be up or down, give or take within a percent or so each day. But these are large cap stocks, and most importantly, there's a lot of overlap in here. The largest holdings or the largest holding is Apple in both of these, and then you go down the line, they share a lot of top weighted components as well. So just keep that in mind. And again, the point that I'm trying to impress is, you see a breakdown in SPY or the ES. If it's not confirmed with a breakdown in QQQ, don't take that sell signal. It's not going to play out. I wait, especially during a pretty resilient uptrend like we're in. Wait for the latter of the two to break or both of those to break down. So let's watch this and see what happens next week. So there's your trend line. Now let's take a look at QQQ and SPY. Here's SPY. I'll just start here. As I mentioned, we did have at this point right here, the recent high was a divergent high. We had some pretty powerful negative divergences. Again, similar to the divergences that we just highlighted on ES. There's your negative divergences. I made note here. We had this trend indicator, the 9 EMA, the signal line for the PPO, is now crossed below zero, and that of course does a pretty good job when that white line is below the zero line, which is a dotted line. The trend is bearish. When it's above, the trend is bullish, and that's what we're looking at here. So we had one little whipsaw signal here, and again, as I say, there's not any one perfect indicator, but right now, that's what we're looking at. Little early and a little shallow right now, but if we continue down next week and we get that line deeper down below the zero line, and again, a lot of it has to do as well with what's gone on recently with this big divergent high, overbought readings and all that good stuff. Let's look at QQQ. Same story, showed you the NQ a minute ago at trendline support, and this is the two white lines. This is a smaller wedge or a rising wedge pattern, I should say, on the QQQ 60 minutes. So if you're a QQQ trader or don't have access to futures, you may want to replicate this trend line. I have that coming off the what are that the lows around May 29th lows, and we're capturing quite a few reactions here, and you may want to lower that trend line just a bit there to capture all those reactions. There you go. So that's what it looks like, and as a matter of fact, I'll set an alert right now. Of course, I'll probably notice if it goes down, takes that out Monday morning or anytime next week. So that's that. Let me get rid of that extra trend line. I don't know where that came from. And then, as I mentioned before, if we do break down, which I still expect it to happen. Trend's still bullish right now and has been for a while. As I covered in recent videos, and I cover all the time. This 9 EMA does a pretty darn good job of defining trends. You can see it's crossed over bullish right here, and it's told you to, the trend has been bullish since then. So, we've had some trend line breaks, but you have to revise these trend lines as we go. And most importantly, what you're looking for, you'll know it when you see it. You'll see this break trend as well as a SPY, and then start to move lower. But we do have some support levels not too far below on QQQ. So let's just take it from there, see what happens next week. All right, let's just keep this video short. I just wanted to go over some of the top, or actually, we'll run through the 11 sectors in the S&P 500, and then we'll wrap this video up. Actually, I take that back. Before we go through the component of the sectors of the S&P 500, which I'll run through pretty quickly, let's zoom out because I have been living in that world of the 60-minute charts lately. And again, it's a function of there haven't been a lot of market developments. If we look what's happened in the last few weeks, the Qs have been stronger than most other indexes, or at least the S&P 500, the broad market. But again, it's a slow grind up. This isn't a very impulsive move. It's been we had a little bit of a consolidation sideways, and we lifted a little bit, and then we've moved sideways again. Now, the point is, let's look at the bigger picture and keep that in mind that it's stretching the upper end of these divergences, but they are still intact right now. I'm referring to divergences on the daily chart of QQQ, and this again paints the a bigger picture. We had a divergent high right here, did lead to a correction, and this is just an extension of those existing divergent highs. And here's a bigger picture. I just flipped over. Now what I did is I went to a 2-day candlestick chart. So every candle here is 2 days of trading action. This covers 4 years. So similar to the daily chart we were just on. But what I wanted to point out, you can see the divergences, big, powerful divergences. And what I wanted to point out here is back in the big 2015 high, which in some indexes and quite a few sectors actually proved to be a bear market, a drop of over 20%. Drawing it out for you here as I go. We did have a divergent high, similar to what we had now. And you can see the QQQ made a sharp thrust down and went on and made a marginal new high. See, if we zoom in here, it took out those previous highs just like it has now. So I just want to throw this out there because what happens is when the markets make new highs, bullishness hits extremes. And I can tell I'm not going to get off topic now. You can pull up the AAII survey. It's on the front page or right side of the chart on the right-hand column. And you can see that we're starting to get that frothiness back in the market again. But what I wanted to point out is back then, you had this, what I call a shot across the bow. That's this box here where we had a divergent high, we had a sharp correction, no different than what we just had in off the January highs so far this year. And the Qs being the leading index, being the tech stocks everybody loves to own, high growth companies, that's what they piled back into. And the Qs made a new high, and then boom, an even bigger correction after that. And so the $1 million question, and we'll have to see some of these short-term trend lines and everything start to play out. Is that what's going on right now? Was this the shot across the bow, that correction, or that, those back-to-back corrections that we had earlier this year with the Qs going on to make a marginal new high, but still a divergent high? Is that going to be the case or not? And let's just look at one more chart. Look at the weekly. There it is. We're still above trend on the weekly chart. But even if we come back to this trend line, that's quite a drop right there. We'd have just to get down to visit that trend line again, we're talking from where we are now, roughly 6% or so, maybe 6%. Let's go to SPY and work our way forward now. This is a weekly chart, 10-year weekly chart. SPY, here's the bull market uptrend line off the 2009 lows, but I also have this yellow trend line that has a very good fit as well. And let's look at that on this clean board here. So we just looked a few minutes ago, we were looking at QQQ on a 2-day period chart that went back 4 years, and I showed you how the Qs had that shot across the bow, then went on as the leading index that it is, made a new high. Again, it's not as diversified as SPY. That's one reason you have other components holding down. You don't have the high-flying tech companies. And you can see as back then in 2015, that initial shot across the bow was the high. It was a divergent high as well. I should have marked it here. We had negative divergence going in there, played out for a correction. There was a relief rally. The Qs went on to make new highs, but the SPY didn't. And so far, that's where we are now. So, whether we continue on and we take out new highs, and this bull market has a lot more to go, just keep that in mind if you're right now, you know, a non-believer this rally, or you're believing in this rally and thinking this market's going to go to new highs. Uh, these things they turn on a dime. This one had a sharp move up, a little bit of sideways action, and then boom, quick sell-off back down that undercut the previous lows. So this correction was at least equal in scope, but again, it took us to lower lows because we started from a lower level. I also want to point out here just how well this trend line fits off those early 2016 lows. A very well-defined uptrend line. A lot of reactions, a lot of reactions. This was a stick save, an intra-week break with a close back above there. And then we broke down, we've been back testing. So this, in my opinion, puts the SPY in a precarious technical position. I think this trend line fits very well. I have a lot of reactions off candlestick wicks and or bodies, or tails, I should say, shadows and bodies, and back testing now. And sometimes you back test for a while before you roll over. So let's just keep an eye on that. Right now, the PPO is pointing up. It's actually starting to curl down. We zoom in here, you can see it's starting to flatten out. We haven't made a bearish cross or anything like that yet. So I just wanted to reiterate that I still think we're going to take another leg down here soon. But you can't bet on it hard yet because you're still above trend, and sometimes being early is the same as being wrong if you're too early and you're stopped out. So we're holding off on market shorts right now, and I will not chase this rally, not at this point. It can go higher without me. There's plenty of individual names out there. We're trading long and short right now, mostly longs that are playing out official and unofficial trade ideas on the site. But again, I am not comfortable with broad market exposure right now. We're just working our way back. This is a daily time frame. This is a busy chart. Forget all these lines. But what stands out, you can see that PPO is starting to turn down here. The RSI is turning down. Those are momentum indicators, of course. So the momentum in the SPY is waning somewhat. And there's that trend line that I just showed you a minute ago, back testing. We were looking at a two-day period chart before, going back 4 years. This is a daily chart going back 2 years. So that's that. And finally, the 60-minute chart of SPY posted this morning after the open. I had mentioned that we had gapped down. We had the divergent high recently. Our trend indicators crossed into a bearish territory, and I was covering ES before. I may have already hit on this one, but I also wanted to mention real quick that as I did this morning, 277.92, give or take, a few pennies. That was pretty decent support. It was at least near term. It was this consolidation area right here. So you can see that it contained all the pullbacks, and now we've gapped down below that. Had we had a gap on the other side, we'd have an island cluster top right now. However, we don't have a gap there. Either way, that's not really important. It says the essence of an island cluster top, essentially, because you have a move up, a period of consolidation, now a gap down below it. Whether this plays out like an island cluster top, which is a pretty reliable topping pattern, the important thing is that this SPY remains above this, or I'm sorry, below this level now. And as I mentioned this morning, that level would act is likely to act as resistance on any back test. You can see we came very close to it today, reversed just shy of it. And again, so that's a level to watch for Monday. Bullish if we take it out, no doubt. And of course, bullish if we can take out those recent highs. However, I'm still favoring some downside here. I'd like to see a little bit more, get this PPO down in deeper territory, especially see this trend line get taken out on SPY. If SPY does take out this yellow downtrend line, almost certainly QQQ will have broken down below that wedge I started with, that 60-minute rising wedge here. All right, so that's that. Now let's just run through the components of the S&P 500, and we'll wrap this up. Okay, I'm not going in order by weighting. You'll notice I have the weightings. I haven't updated this in the last couple months, but give or take, within a percentage point on these weightings. So here's telecom, not a huge component of the S&P 500. It comes in about a 2% weighting. But the big picture is this sideways trading range now. It's going on for close to 2 years, well over a year and a half. and we're at the top of that range. You can probably see it a little bit better here on the weekly chart. Yeah, there you go. So you can see a lot of reactions there, and the momentum is up right now. We're at the top of the range. We've been moving higher in telecom. These momentum indicators, the RSI, the PPO are pointing straight up. However, there is substantial divergence. So my guess, based on this, we're making a run at it. And in this market, normally if you go out to test a high, you're going to take it out. But I don't think that will be long lasting. So my preferred scenario is we pop above here. You'll probably see a pretty big green candle, some volume come in because that'll be a breakout over a, an 18-month trading range. But then I think hard to say when, whether it's days or weeks, probably somewhere in there. Probably see XLT fall back into that pattern and then move all the way back down below, or at least to the bottom of the pattern there, and confirm these divergences. And if that does happen, now in other words, we don't have to move down to all the way to the bottom. If we come back in here pretty impulsively, if we do get a breakout and it fails, it will most likely confirm these negative divergences, and those are pretty powerful divergences right there that have been building throughout this 18 or so month sideways trading range. So there's something to watch. Telecom as well as the individual telecom stocks. Healthcare has been doing well lately. I've highlighted a few names in the trading room. This is one sector I've liked. Looks pretty good here. We did have a big divergent high right here. However, we hit trendline support. This is on a weekly chart now. This goes back to the 2009 lows. You can see healthcare or XLV is defending that trend line, and the PPO is rolling up right on the zero line. I often talk about that. This is a great trend indicator, often acts as support when tested from above. So as of now, can't knock it, but if we break down below that trend line on a weekly closing basis, that's not going to be good. And again, that is looks like it will happen at some point in 2018 based on these large divergences, but we'll have to see. Divergences aren't the be all end all, and they're not a sell signal. They're far from it. They're just an indication that a trend change is likely. Sell signal will come on an impulsive break and a solid weekly close below this uptrend line. Next up, real estate. It's only about a 3% or so weighting. It's been doing relatively well recently. XLRE is the Spiders real estate ETF. Here it is on a weekly chart. You can see it's at the top of this trading range right now. So we're working our way up in this price channel, I should say, just as we were right here. This price channel broke down. So all I can say, we hit the top of the channel. We've moved down pretty impulsively this week. You can see about a 1% close today and a big red candle, and that's REITs. So I think in the near term that it's probably time to book some profits. We also had a big fat bearish engulfing candle the other day. That was on the Fed meeting. Fed came out with a more hawkish than expected expectation going forward, so that hurt these interest rate sensitive stocks and sectors like REITs. So there's another reason to really not stay much later to the party if you haven't already done so, meaning take profit. XLP, have been bullish on this one recently. Put out a video of a lot of bullish setups in the sector. One of the better looking ones, we broke out down above this downtrend line. We had positive divergence, which I like to see, just like we had negative divergence at the high up here. You can go back and see all the divergences marked led to these swing tradable trends. So far this one looks good, and if the market can hold up, then there's more upside to go. If we have if the market were to start selling off pretty hard, this may not make it all the way up here, but this is my target as of now, my preferred swing target, and that's just over 52.50. You can see there. Again, market willing, that's where I think XLP heads before any significant reaction or pullback. Okay, next up is XLY. This is Spiders Select Consumer Discretionary ETF. Consumer discretionary makes up 12.6% of the S&P 500, about 13%. Actually, I should just call this Amazon Class B shares. The reason is XLY is 22% weighting, has a 22% weighting in Amazon. So about 1/4 of the performance of this sector, which also makes up a pretty good chunk of the S&P 500, is attributed solely to one stock. So as long as Amazon's got gas in the tank, the consumer discretionary sector holds up. Uh, Number two behind it is Home Depot, and then Netflix, number three, and then Disney, Comcast, as far as the weightings go. But they're all a distant second again to Amazon. So, what do I see? I see a sector that continues to diverge up. And these candles, I'll tell you, I'm not very comfortable with these candles. When you see these small candles, this isn't a slow, steady grind up. Usually these end with something like we had here. We had that slow, steady grind up. We had a few red candles in there, and then boom. The rush for the exits after such, near vertical lifts are usually pretty swift. So just be careful. If you want to, keep the momentum going, trail stops. If you're along that sector, great, but just don't become married to it because when it finally breaks, probably again see some pretty quick selling. That's XLY. Let me see if anything jumps out to me on the weekly chart. Yeah, the weekly chart, the trend indicators are pointed up. Recently made a bullish cross on the PPO. The RSI is pointed up, but you can see these divergences. They're not confirmed yet because we still need to put in a lower low, or I'm sorry, lower high on the PPO here via a bearish crossover. In other words, the PPO needs to turn back down and then make a cross. So these divergences could start to, they could be finalized at about this angle, anywhere up here. There's a ways to go. So you can't short it based on divergences. There's nothing remotely close to a sell signal on this sector right now. Focus on that daily chart. But what I think will happen in the coming weeks here, I think sooner or later we're going to have a big bearish engulfing candlestick that's probably going to wipe out about anywhere from a week to 3 weeks or more of trading in XLY. That's my guess. I've seen it before, and it's again just from my read on the chart. We'll see what happens, but I wouldn't be chasing this one, nor would I be chasing Amazon here. XLB, this is basic materials, only about a 3% weighting in the S&P 500, so really not going to make or break it. You can see an uptrend line here. Here's a primary uptrend line. Better to look at a weekly chart on this one. This paints the picture a little bit better. I have two alternative trend lines. Let me color this one a little brighter so it'll stand out here. That color looks good. All right, so there it is. We have this trend line here, which we've broken below, and we're almost back testing. And then we have this trend line off the lows, both of which we've broken down below. This pinkish trend line we broke, back tested, and rolled over. So you can't really knock it too hard. You're seeing that PPO is still bullish, still above that zero line, and starting to curl up as well. So I'd probably stay away from that one right now. Don't know if I'd jump in if it's worth taking along. I'd have to look at some of the individual names, but let's move on again because it's not one of my favorites. XLF. This gives me a little concern for the market, as I'm sure others. XLF, this was a primary uptrend line. In fact, we have to go back here. Let's look at it on a 2-day chart. That's nice and clean. See this divergent high, extreme overbought reading. I don't think the financials have ever been this overbought in history, if I'm not mistaken. And that ended with a big bang. Big bearish engulfing candle. Actually, no, take that back. It didn't engulf the previous days, but it was a huge red candle. And the financials have been in an unmistakable downtrend since. So they peaked back in January, and the financials are an important part of the economy in the S&P 500, and they have been in a clear downtrend, but they're hovering right over this support here, right around 2675, give or take. You can see a lot of reactions there. That's the level to watch. You want to see if you do see a big red candlestick and a weekly close below that level, a solid weekly close, that should be lights out. And I think it's going to come. Otherwise, I'd be saying let's look at financials here, buy off support. Um, there's two ways in trading. When you see a stock or a security or an index fall to support, you can either look to go long if you expect the uptrend to continue, or you look to position short. And based on everything that's on this chart, the extreme overbought conditions, the bearish price action, that big divergent high, and the fact that the PPO trend indicator you can see for the going back again, this one it's done a really good job on XLF. Here it is. I'm trying to use my box tool. All along here, it was saying the trend was bullish. It was above that zero line, and you can see it's crossed and it's still below zero now. It's testing it from below, so that's concerning. I think if the financials can't get up here through this downtrend line, they're going to be in trouble. They've already broke down from that primary trend line, back tested, failed, went for another back test, failed again, and you can see I had positive divergence down here, which is rare. We haven't seen that in a while. We had a divergent low on the daily time frame. So you might say, well, Randy, it's good, isn't it? Well, yes, but only if it plays out. Now, I would expect a divergent low. We're in a bull market. NASDAQ, well, tech stocks are screaming to new highs, but not financials. What's going on here? Something's wrong. And this divergent low should have played out for more than a rally. Given you could have a counter trend pull back once you have a divergent low, but look, we're coming back down and testing those lows again. That's just not healthy, and that's telling me that the landscape or the character of XLF has changed. During a bull market, you get these oversold readings, you get divergent lows on the daily time frame, and that is good. They usually explode and take off from there. We're not seeing that now. So everything I see on the financials tells me there's something to be concerned about there. I suspect it has a lot to do with Deutsche Bank. I know that's a German bank, but this is huge. If after all this time, all these talks about this stock is still it's about to make another run at these recent lows that it put in back a few weeks ago. Not looking good. There's something going on there, and obviously there's the potential for some systemic problems in the financial system if this bank goes down. They have to be bailed out. So I don't know. Maybe that's what's going on with the XLF. Maybe not. We have interest rates are going up. It should help the financials, but it's technology, or should I say QQQ, Class A or Class B, whatever you want to call it. You mirror chart. XLK mirrors the QQQ, the Nasdaq 100, because it's most of the same companies. Majority of companies in the QQQ are tech companies, same ones in here. So the charts look the same. Divergent high, just like the Qs, right at trendline support. You can see a lot of reactions here too on XLK. You can see numerous reactions on this daily trend line here. We're walking up, and wow, looks like we just closed below it today. Not an impulsive breakdown. I can pull that trend line up there, but you can see that little doji candlestick just below trend right now. So let's see what happens next week. Let's see if there's follow through the downside, or if this is just another false breakdown on the road to new highs. We'll see. But it's clinging to those divergences by a hair. Just made a bearish PPO crossover. The RSI is rolling down. And again, that's an important sector to watch. And if you go back, again, this trend line will look similar to QQQ, really, almost identical. A couple more and we're done. XLU utilities, obviously rate sensitive. They had a breakdown here, came up, back tested this trend line or this price channel from below, impulsive sell off, and I'm neutral on these. I think most of the rising rates have been priced into these guys. If you have some utility stocks and you're looking for an all-weather portfolio, diversified portfolio, um, I think there's some buys in that sector right now. This chart gives me a little concern because you have this long-term trend line off 2009 lows, broke down, we back tested below and kind of wedged up. When you look at this, we wedged up there, broke down, and we're rolling over. But I think we'll come down here. If we do move a little lower, we'll hit this 47.25 support level, probably get another reaction there. This is clearly in bear market territory. So again, like any stock, if you're holding these, buying these for dividends, don't get married to it. We could be in a new secular bear market or cyclical bear market within utilities, just like possibly in the financials and quite a few other sectors. Remember, it's tech and just a couple others that are pushing to all-time highs, where a lot of other sectors peaked back in January. So that's XLU, and the only other one left to go, I believe, is XLI. Now we have energy too. I have to get to after this, and then we're done. XLI, I'm on a weekly time frame. You can see it's below trend. So here's another one that looks good on face value when I go to the daily chart. But again, weekly trend line for that trend line generated off the January 2016 lows. We broke down, back tested it, and we're still below it. PPO looks like it was poised to make a bullish cross, but again, these are the things I'm watching, because if this was a top in a lot of sectors as well as the S&P 500 back here in January, what you're going to expect is a change of character. Why this might look like a bullish crossover, it hasn't happened yet. And sometimes, like you can see here, when these lines look like they're about to cross, they kiss and they roll back down over. So right now, that line's flattening out. This might be a rejection with the signal line, the PPO line on the signal line, and that would be bearish. And of course, if we take out that 71.79 level on a weekly closing basis, that would be bearish too. And ultimately, before the next bear market's said and done, I think the industrials come back down here, XLI, back to about 58.64. But there's some work to be done before we get there. So that's that. And here's the daily chart. Like I said, this doesn't look so bad because we had a divergent low right here. Pretty clear divergence on the RSI. So there's your divergent low. We had a nice rally and we took out. We had a reaction. Look at this yellow trend line. How many reactions on it? A bunch of reactions. We broke out above it. We back tested. So that would normally be okay, load the boat. This almost looked like flagging action too. In a bull market, a strong bull market, when you see this, you see a breakout and a back test, it should be off to the races. Maybe it's just another pullback rally, kickback rally, or I'm sorry, correction here. But that shows me that this little rally and these bullish chart developments are getting sold into. And again, that is more characteristic of early stage bear market price action than powerful. We're going to new highs throughout 2018. Get on the bull train stuff. Just my opinion, guys. And last but not least, we have XLE, the energy sector ETF. Charts speak for themselves. This one was one of those runs where, at the end it looked like it was never going to stop. And that's how a lot of bull runs look, especially the energy stocks. That's another thing. You have to analyze each security, each sector is unique. And the energy sector it tends to trade like this. You have these near vertical runs and they're followed by sharp corrections. Near vertical runs and a nearly vertical plunge. So there it is, and that's what we had here. And so far, and again, it wasn't just the fact that we went up a lot or got overbought. That's just a small part of it. This is what tells you you're topping here, and these were pointed out before and afterwards. Divergent high, negative divergence here on the RSI. Looks like we were trying to make a bullish cross here, but you can see that PPO line rejected now and pointing down. And again, no surprise because you just track crude. Let's pull a chart of crude and we'll wrap it up. And this is what crude's done. We had this rising wedge. Crude oil broke down, impulsive selling below the bearish rising wedge. Yes, confirmed with divergences. We had a bullish rising wedge here. I'm sorry, bullish falling wedge, positive divergences, breakout, back test. I'm referring to this line right here. That's the wedge. This was just an alternative uptrend line, which we then took out. But then we wedged up here, and it looks like I missed a trend line here. And that's that. So yeah, sure, there's news, but I always say this. News, actually, that's why I didn't have a trend line there. There's no divergence on that line, just the bottom line. News tends to follow the charts. That's been my experience. So anything coming out of whatever the Saudis are saying now, I'm just glancing the headlines recently. It was priced in. You can see a very well-defined uptrend line there on CL. These are crude futures, by the way. A rising wedge, a breakdown, and impulsive selling. So, and again, that's why the energy stocks are moving lower. So I don't really see a reason to step in and buy. Counter trend rallies are always sharp in crude, but again, I'm looking at the longer term picture and not liking what I see. All right, this has been Randy Finney with Right Side of the Chart. Again, we'll see what happens next week and we'll go from there. Have a great weekend, guys.